On paper, the Indian economy is expanding at an impressive 8.2%, but the messaging from the highest levels of government has taken on the tone of a nation entering a period of extreme austerity. In May 2026, Prime Minister Narendra Modi appealed directly to the public to postpone foreign trips, halt gold purchases, and cut cooking oil consumption by 10%. He framed these reductions in basic needs as essential acts of patriotism to preserve the country's foreign exchange. The fastest-growing major economy in the world is demanding its citizens ration daily goods, a request typically reserved for times of deep national recession. This chart reveals the disconnect between the official narrative and the labor market. While GDP grew by 8.2%, the informal manufacturing sector simultaneously lost 9.3% of its workforce. That represents 2.7 million jobs disappearing in a single quarter. These top-line growth figures mask a systemic deterioration at the very foundation of the Indian economy. In Surat, the world's largest diamond hub, factories have fired 60% of their workers. Families who once enjoyed financial stability are now seeing salaries cut in half, forcing them to move their children from private schools into the government system. If millions are losing their incomes, it remains unclear how the market for cars, electronics, and home appliances continues to show strength. The surge in household debt explains how demand persists. By 2025, debt reached 41.3% of GDP, with 55.3% for non-housing retail loans. Citizens fund daily necessities through high-interest credit card installments, financing survival through debt rather than wealth generation. This borrowing is a response to shrinking earning power. Data from the International Labor Organization shows that the average inflation-adjusted salary is actually lower today than it was in 2012. India's consumer market is a debt-fueled illusion. With 90% of the population struggling to fulfill basic needs, the public has no financial buffer to survive external shocks. That fragile equilibrium broke when the U.S. imposed 50% tariffs on Indian goods in late 2025. These levies directly threaten tens of billions in export revenue. Manufacturing hubs like Tirupur face total duties of up to 64%, a severe disadvantage compared to competitors like Bangladesh. In this city alone, 150,000 jobs are at immediate risk. To ease these tariffs, the government abandoned discounted Russian oil in favor of American and Venezuelan crude, which must be paid for in U.S. dollars. This chart shows the resulting drain on foreign exchange. The rupee fell to a record low of 96.90 against the dollar in 2026, becoming the worst-performing currency in Asia. Simultaneously, the Iran war led to a blockade of the Strait of Hormuz. This immediately halted the flow of 55% of India's oil imports. While official inflation was reported at 3.93%, the real cost of essential fuel and fertilizer spiked. For the poorest citizens, the actual inflation rate reached nearly 60% as black market prices for gas cylinders doubled. A debt-burdened, import-reliant economy is defenseless against these geopolitical shocks. In this system, foreign conflicts translate directly into domestic poverty. Beyond trade shocks, India's most stable middle-class sector is facing a domestic technological displacement. The World Economic Forum projects that artificial intelligence and automation put up to 500,000 IT jobs at immediate risk. A single employee utilizing AI can now execute the workload of 5 to 10 traditional workers. This efficiency allows companies to maintain output while hollowing out their existing workforces. This technological shift is hitting the white-collar middle class with the same speed and severity that tariffs hit the industrial sector. As these crises compound, the government remains unable to open its treasury to stimulate the economy or protect failing industries. National debt has ballooned to 197 trillion rupees, pushing the debt-to-GDP ratio past 81%. This balance sheet reveals a fiscal trap. Interest payments on old debt consume 25% of all revenue. Salaries and pensions take another 43%. Once basic obligations are met, over 80% of government income is already spent. Despite this lack of crisis funding, the government continues massive expenditures on political advertising, billboard campaigns, and high-profile international tours. Meanwhile, a severe El Niño event is beginning to destroy agricultural yields and drive up rural unemployment, adding a natural shock to an already brittle system. India simply cannot borrow its way to prosperity. Fixing the economy requires abandoning the illusion of debt-fueled growth and addressing the grim financial reality of its citizens before the system collapses.